today we start on Ulips. Now, in recent times, Ulips has become extremely popular and a lot number of investors are actually talking in for Ulips. It is a good product, no doubt, but the popularity is more in terms of the insurance companies trying to popularize it, because they have their own advantages to propagating Ulips. Right? Just to understand what the term Ulips means, it's basically an amalgamation of insurance as well as a mutual fund. Right? Now, when you invest in a mutual fund, you buy units at NAV, right? And after a certain point of time, you decide to redeem it, and whatever capital appreciation or if it's a dividend plan, then whatever dividends you get, and at a certain point of time, the majority benefit is given to you. Right? Now, in a unit plan, right, it works in exactly the same way. Right? Now, only thing is that you buy units at NAV, but in terms of that, there are 2 or 3 types of charges of this. Right? Now, one is a mortality charge, and one is an administration fee. Right? Apart from that, there may be some switching costs and some administrative fees and stuff. That is something different again. Now, what happens in a mortality expense? Mortality expense, because it is a combination of insurance as well as investment, there is a sum assured that in case you die before the particular maturity period, right, you will be paid a sum assured. Right? Now, whatever premium that you pay, okay. Now, in the first couple of years, the charges are extremely high. Right? In fact, in the first year, it can be high as almost 30% of whatever you pay. Right? So at least 30%. For example, if you are paying 10,000 rupees as premium, right? So you will start up with only 7,000. Right? Because in the first couple of years, they actually deduct the entire mortality charges. Okay? Now, the sum assured, the minimum sum assured, what they have said is it can be something like term by 2, right? Whatever is the term by 2 into the annual premium, or 5 into the annual premium. Right? That is the minimum sum assured. That is what the guidelines of IRDA says. Right? There is no maximum assurance, but in general, you will find that insurance companies will stick to this sum assured at whatever your annual premium is concerned. For example, if you are paying 10,000 rupees as premium, so in that case, the sum assured that you will get is minimum of 5 into 10,000, 50,000. Or for example, if you are, let's say, opting for a 25-year term, right? So 25 by 2, 12.5 into 10,000. So you make your calculations accordingly. Whichever is the minimum of the two, that will be the sum assured. Right? Now, because it is an insurance plan, right, the mortality charge will actually depend on your age. Because, for example, you are entering the plan at 25 years of age. Obviously, in that case, you will be expected to have a larger life expectancy. So, therefore, the charges will be less, right? So, whatever, let's say, assuming you are paying 10,000 rupees as an annual premium, so there will be a certain amount that will be deducted towards mortality charges and a certain premium that goes towards your investment fund. Okay? Now, as I said, in the first couple of years, right, the mortality charge is low. Right? So, practically, in the first 2 or 3 years, you don't actually get anything in terms of investment. Right? In fact, it will be a wonder that because after 30%, then they have something like 18%, then 12%, and then finally it boils down to 3% or something like that. Right? It will be a wonder if at the end of 3 years, if you decide to surrender your policy, you might actually get nothing. Right? Because in terms of whatever your investment value or whatever it is, so it will be just a sum total of your premiums, whatever the charges minus your charges and stuff. So it's probably going to be a very low amount. Right? Because in the first 3 years, as I said, they deduct the entire mortality charges towards your insurance. Now, the way it works is that a certain amount of portion goes towards paying your life insurance premiums, and certain portion goes into an investment fund. Right? Now, the investment fund, they have options. Like you can have an equity option, that is a 100% equity option. You may have a 70%, 30%, right? You may have a 60-40%. You may have 70, when I am saying 70 means equity, 30% debt. 60% equity, 40% debt. You may have a, in the reverse way, a 30% equity, 70% debt, or a 60% debt and a 40% equity. Or may you have even something like 80% debt and 20% equity. Or you may have something like, let's say, mostly debt, maybe 10% in cash and something, and the rest entirely, so the very safe floater kind of a fund, which is entirely into debt instruments. So that is a very, very safe instrument. Now, depending on the type of fund that you invest in, right, the administration charges in terms of portfolio management charges are separate for each kind of fund. Okay. Now, when you invest in this, okay, now out of the 10,000 premium, first year mortality charge is maximum, and little bit goes towards your life fund, right? That is your investment fund, right? So, for example, as I said, 30% is towards expenses, so 7,000, right, towards your expense. Then next year again to 10,000, so again they'll deduct mortality charges, right, and then it goes towards your investment fund, right, plus whatever administration. For example, as I said, if it's an equity fund, they'll charge you more in terms of portfolio management fees. Plus they'll have some administration charges which is fixed, like 180 rupees or something, right? So your fund is supposed to increase year by year. Now, should you die at somewhere between the policy, right, you will be paid higher of whichever the sum is there, right? Now, for example, let's assume that your sum assured is 3 lakhs, right, and your investment fund is, right, 2 lakhs. In that case, if you die before that, right, now they will be paid 3 lakhs for your sum assured, and your 2 lakhs is not paid in that case, right? Most people will actually prefer, logically, it's better to buy a pure whole life or a term insurance plan and a separate mutual fund, right? Simply because in this case is that there is more transparency in a mutual fund. For example, in a mutual fund, they are supposed to disclose a quarterly portfolio, right? Whereas in a ULIP, right, there is no mandatory disclosure of portfolio, right? Plus, in a mutual fund, they have some limit in terms of the amount of expenses, in terms of percentage of expenses that you can charge. Here again, there is absolutely no, in terms of limitation for the type of expenses that you charge. In fact, IRDA has come up with a note that these expenses are too high. For example, 30% is very high, right? Even to break even on the scheme, right, you need something for 10 years, right? So, if you are investing in it for a long term, right, as I said, a ULIP is useful in only 2 cases. Either you die very early or you die very late. Right? Either you die very early, when I say early, because, for example, let's say your life fund hasn't accumulated, if you haven't actually invested so much as your life fund, right? But because it is an insurance product, right, and you die before, right? So even though you may not have invested enough, but you have to be paid the sum assured, right? There is no reason for you them not to pay the sum assured because it is an insurance product. So if you decide to die early, right, so you will at least get the sum assured, in spite of the fact that you have not built up enough value in terms of in the product, right? But if you choose to, let's say stay invested, and let's say you're somewhere between the 10th or the 11th year, right, it doesn't make any sense because you will be paid whatever is the higher of the two. Either it is the sum assured or whatever is the investment value. It is only when the sum becomes more than the sum assured, right, then in that case you will be paid the whatever is the investment value. In that case, you have made some returns on your investment, that is sum assured plus whatever it is in terms of the cumulative value of your investment. So only in that case it becomes a feasible proposition. So as I said, either you die early or you decide to wait some time and right. The problem comes is that they are paying an extremely high charges to brokers. Right? None of it is disclosed to the investor, right? And the brokers are going all out to sell it because of the fact that they are receiving high premiums. So the investor is not really aware of what are the charges, what is his actual net benefit that he is getting. Because in practicality, he may be just better off with buying a term insurance plans and a mutual fund. There is actually no sense in buying a unit. Right? Combining an insurance product with a investment product, it doesn't make any sense, as I said, because you have to wait for a long term. Right? So if you are going in for protection, let's go in for protection. If you are going in for investment, then stick to a mutual fund. Right? Of course, it has options, as I said, in terms of floater, in terms of equity, debt combinations. You have 4 or 5 plans. All mutual funds will offer those kind of plans. Number one, in terms of the disclosures also, it may not be very high. Right? But yes, if you are looking in terms that you don't have to manage your investment portfolio, you opt for a plan. They have some, you decide to change your option. For example, you want from a debt to equity plan. They'll charge you some switching charges, and they'll switch off your plan and say that okay, you want to move from a debt to equity, so they'll charge you some plans, and then you can do that, right? So, for example, you want to top up your plan, right? Now, top up your plan doesn't make any impact on your mortality. Okay? For example, now you've normally locked in for a 10,000 rupees premium per year. Okay? Now you decide that I want to pay in a particular year another 20,000 more, right? So that goes towards building up your investment portfolio. So that is something that you can do. In fact, now IRDA has come up with a regulation that if you pay the top up, which is more than 25% of your sum assured, which is 25% of your sum assured, then there must be some allocation towards your sum assured, right? Otherwise, the top ups immediately went towards building up your investment portfolio, right? But now the IRDA has come up with a regulation that if your top up is something like 25% of the sum assured, then in that case there must be some allocation that must be going towards building up or increasing your sum assured, right? So that is there, right? So otherwise, it has the other advantage, of course, is that it is a 100% tax exemption because it comes under Section 80C. So it is in terms of that a product which is like you can use it for retirement, right? Insurance come investment, because it saves you from the trouble of trying to have an insurance product as well as an investment. So it's a combination that also it makes life a little easier, right? But it's okay for a retirement product, provided of course you are getting the returns on it, right? Because provided of course you understand the charges, provided of course you understand the implications of surrender values and cash values and so on. You understand the charges, okay. The other thing is that when you are looking at Ulips, you must be very clear about why you are investing in it, right? Your game plan should be very clear that is it you are wanting more for insurance or more for investment, right? Because people don't understand the product and they still go and invest in the product. Okay, so this is very important in case of a ULIP, that you should be having a look at whatever is the fine print on that document. That should be very, very clear. Okay, so these are some things with regard to basic ULIP product. See, they are also there investing in investment options. Okay, the main thing is that what is the value of your investment? Right? They may declare a bonus, right? There is nothing as guaranteed out there. So at a certain point of time, they feel that the fund has done well, so they put a bonus and they will say that okay, this is the amount of your investment portfolio is now. That much they will give you the amount, right? But in this case, because it is an NAV based, right, you have a very clear idea, right, that how much your fund is going on, right? As I said, suppose you have let's say invested 10,000, right? And let's say at that point of time, right, you have the NAV is 10 rupees, right? So you got 1,000 units in your NAVs, right? Now in that case, in the first year invest, as I said, 30% of your whatever charges now, so your NAV boils down to 7, right? Then they will invest in it, and then it will take some time, right? And after some time, right, when it has begun to earn some investment after deduction of all charges, etc., 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 then it will go up to maybe 12, 13, 14, and depending on the number of years or the investment performance, and it will go up to there. The important thing is when they are selling the Ulips, right, and now IRDA has come up with the regulations, when the agent is selling you the Ulip. Earlier they used to make projections that you will get something like something like 22% per annum or 25%. So they will tell you the final years, and at the end of 25 years, if you invest, let's say 15,000 rupees per year, right? Now the value of your portfolio will go to something like 25 lakhs, right? Now the moment you say 25 lakhs at this point of time, and for the investor says 22%, 25%, he says okay, my portfolio is going up to 25 lakhs. So immediately he feels that this is a great investment. Okay? But the fact is that there is no investment, even a stock market, over a 25-year period will not give you 22% and 25%. That's impossible. Right? Even if I am investing in pure equity, is it possible to earn 25% rate of return? It is not. Right? So in that case, making an illustration which gives you 25% rate of return is ineffectual. It is actually cheating the customer. Right? So IRDA has come up with a regulation that if any illustration that you want to show as far as a unit is concerned, it should not be either 6% on lower rate or 10% is the maximum rate. Okay? Beyond 6% and 10%, no insurance advisor is supposed to illustrate the working of a unit beyond those rates. Right? On all websites, everything, you possibly cannot show an illustration of beyond 10% rate of return on your investment portfolio. Right? That is the maximum. Right? And depending on the kind of plans that you have, right, it should be very clear cut. Right? Secondly, what they have done is that whatever illustration sheet, right, for example, you have opted for let's say a 15,000 rupees premium and you are let's say 35 years of age. Right? Now they will calculate your mortality charges. They will calculate the approximate rate of return, right, on either 6% or 10%, depending on whatever it is. They will make the illustration file, come up with an Excel, some figures and stuff, and you have to look at those figures and you have to sign on that. Right? Until unless you don't sign on that sheet, right, your application for buying an ULIP is not accepted. Right? Because the reason why IRDA came up with this is because the insurance companies were selling it like cakes or something of that sort, right? Because obviously the insurance advisors, because of the fact that they were getting very, very high premiums, okay, and when I say high premiums or very high premiums, which are not disclosed anyway. Right? When you say 30% charges, now 30% cannot be mortality charges, right? So there is no division between what is mortality charges and what is the expense that you are giving to the broker. Right? So because of the high premiums involved, you would find that all the insurance advisors would try and push a ULIP product to the maximum. Okay? So in the process, the investor was getting cheated. Now, beyond let's say 1 year or 2 years, now if he decides to withdraw from the plan, right, and he decides to withdraw from the plan, he is not understood the clauses. Right? What he realizes that he gets absolutely nothing, right? And they have minimum lock-in of 3 years. You can decide to withdraw if there is an emergency or something that you can decide to cover. The surrender happens only after 3 years, right? They have a lock-in kind of thing. So in that case, after 3 years, you find that you are absolutely getting nothing. So the investor felt cheated. So that is why the IRDA came up with this regulation that whatever illustration or whatever projection that you are making, right, they cannot be beyond 10%. The investor has to sign on the sheet. He has to understand the charges, the minimum sum assured, right? Because they could play around also with the sum assured. They had to disclose the mortality charges separately, the administration charges separately, the switching charges separately. Everything has to be given separately to the table and not clubbed together. Right? And the minimum sum assured, as I said, is either 5 times the annual premium or whatever is the term, 20-year term or 25, divide by 2 into the annual premium. So whichever is the least of the two would be the. Right? It's basically they have worked out a formula. They have basically worked out a formula that this is the minimum sum assured. Below this, no insurance premium can offer you a lower sum assured. Right? This is the minimum. They can be more than this, but below this, the insurance company cannot